One of the best ways for you to build wealth if you're a 9-to-5 worker is by investing in your employer's 401k. I spent 8 years working 9 to 5 at a huge corporation, and over that time, I was able to grow my 401k to over $100,000. That's despite me never earning more than $65,000 any single year that I worked at that company. The easiest way to make your money grow is through compound interest, and it really helps when your employer offers a plan that allows you to grow your money, so you might as well take advantage of it. In today's video, you're going to learn how to open up a 401k if it's something that your job offers, and I'm going to point you in the right direction to opening up your own 401k if you're self-employed like me. And most importantly, I'm going to teach you 2 ways that you can invest into your 401k. I've tried both methods myself. They both work equally well. So it's really just personal preference on which method that you like to use. By the end of this video, you're gonna have a crystal clear idea of not only how to open a 401k, but what investments you should be making so you can be growing your money in the best way possible. In case you don't know what a 401k is, it's a retirement savings plan that's offered by your place of work. In case you don't know what a 401k is, it's a plan that many jobs offer that allow you to invest some of the money that you earn at your job so you can have it for retirement. The best part about the 401k is that the money that's invested is pre-tax, meaning that they don't tax you on the money before it goes in, which means you get to save a lot more money up front. It also reduces your taxable income, so when tax time comes, you can report that you made less money than you actually did because you invested a lump sum of that pre-tax. When you enroll into a 401k, or when your company enrolls you into a 401k, you're basically agreeing to put a percentage of your money into an investment account so you can have more money later. The best thing about that is many jobs offer what's called a match. That's essentially them giving you free money. The way it typically works is they'll match you up to a certain percent. Let's say you decide to invest 10% of every paycheck into your 401k. And for easy math, let's say your paycheck is $1,000. So your first $100 is going to be put into the 401k where it can grow. Well, every single paycheck, every single month. Your company is going to match, let's say, 5% of the 10%. So for every $100 that you invest, your company is going to chip in an extra $50 for you to invest as well. There is a thing called a vested period, which means you have to meet certain minimum requirements at your job, and that varies from job to job. So you'll have to ask HR about when your vested period is and all the details surrounding it. But once you're vested, meaning that you've stayed at the job for a certain amount of time or that you've met other criteria, that money is yours to keep. So you get to invest the $100 that you were already investing, and then your company is going to invest that 5%, that another $50 on top of that. Like I said, it's not always going to be those solid numbers. The company that I used to work for, I believe, was 6% that they would match. I believe the NFL is like really generous. I think they match like 100% of your 401k contributions. It might be 150%. I can't remember off the top of my head. Anyway, once you invest that 401k money, it grows year over year, tax deferred, which means that you're going to pay taxes on the money once it gets withdrawn after you've met retirement age. Opening a 401k as an employee is pretty easy if your company offers 401k plans. You normally ask HR and they'll point you in the right direction for opening the account, and if you watch the video to the end, I'll even teach you about ways that you can fund the account to make sure that your money grows, because you deposit money into the account, but the money also has to be invested into something for it to grow. Otherwise, it's almost just like a savings account. It's just going to grow at basically the money market rate. So you have to make sure that the money that goes into the 401k gets invested. Normally, that's something that you have to do just one time, and then once it's set up, it's something that takes care of itself from then on. There's a separate type of 401k if you're self-employed like me called a solo 401k. You can get those at some of the same companies that offer your work 401k, such as Fidelity or Charles Schwab. So for my self-employed people out there, you can definitely still take advantage of a 401k. I'll leave some links in the description. None of them are going to pay me or anything like that. I just want to be able to point you into the right direction for resources, because this is something that I definitely could have used when I was coming over from working a full-time job and was wondering, what do I do in my old work 401k? Finally, we're going to move on to investing into your 401k. There are 2 methods to invest into your 401k. One is very easy and I highly recommend it. It's really just a few clicks of a button. And the second one is a little bit more manual. I've taken advantage of both methods in the past. Honestly, method number one is going to be the easiest, and there's not really much difference in the rate of return. So it's really completely up to you which method that you want to take. But method number one is investing into what's called a life cycle fund or a target date fund. These are low cost funds that grow as you do. What I mean by that is when you're young, you want your investments to be aggressive because you have plenty of time if you have a loss to recoup that loss. So you like to have more aggressive investments while you're young, and the closer that you get to retirement age, the more conservative you want your investments to be. Because once you're, getting up to 60, 65, you want your investments not so much to be earning as much as possible, because the more that you can earn in your investments, the more risk you're exposing yourself to. So by the time that you're older, you're going to be looking and solidifying the gains that you've made over the past decades that you've been investing. So when it comes to choosing that type of investment, you're going to be looking for an option called target date fund. So it's going to be labeled target date, and then it's going to have a year. It's going to be, for example, target date 2060. That means that your target date fund will be mature in the year 2060 when you expect to turn 65 years old. So that assumes that you were born in 1995. Let's say if you were born in the year 2000, your target date fund that you would be looking for would be when you're at the age of 65, 2065. And it normally goes by the year that ends in a 0 or a 5. So let's say you were born in 2002, you're going to round down to 1965. If you were born in 2003, maybe you'll round up to 2070. That one's going to be personal preference. Just know if you choose to round down, your investments won't be as aggressive, meaning you might end up with slightly lower returns than you would have if you would have picked the higher option. The second method that I've tried is known as the Yale model. It was popularized by David Swensen. David Swensen served as the chief investment officer of Yale University's endowment from the 1980s until he died a few years ago in 2021. While at Yale, Swensen changed the model from 60% stocks and 40% bonds to a more diversified approach. The logic behind this is diversification across various asset classes will minimize your risk, which means you can take more aggressive investments and still minimize the risk that you have of losing all your money. I'll explain the breakdown shortly, but the only drawback to using this model is that it can get out of balance because one sector will grow way faster than the other, and you'll have to manually rebalance every 6 months or every year depending on how often you want to go into your account and manually change things. The Yale model is broken down as follows. 30% of your portfolio is going to be the total stock market. That means you're going to buy an index that tracks the S&P 500, and that's going to be 30% of your portfolio. Another 15% is going to be the international stock market. An example of this would be the MSCI World EX USA, which means it's excluding the United States. Because if you have a global fund that includes the United States, you're essentially having the 30% that's tied to the US stock market, and then if you had another 15% that also has some ties to the US stock market, if the US market dips, you're potentially dragging down a lot more than 30% of your portfolio. So making sure you exclude the United States in that 15%, you're protecting yourself from having a major dip in your portfolio if the US markets decide to contract all at once. Emerging markets, or EEM, is focused on the stocks of emerging economies. It represents only 5% of your portfolio because it can be kind of risky because you never know what can happen with smaller economies, whether they're going to go up or down. So you want to take advantage of some of the gains that they have, but if they have losses, it's not going to hurt you too bad because it's only 5% of your overall portfolio. The next 15% is going to be intermediate maturity bonds. These bonds are expected to be paid out anywhere between 2 years and 10 years, and they're usually very safe investments. An example of this would be known as a T-bill or a treasury bill, which is issued by the US Treasury in terms of 4 weeks, 13 weeks, 26 weeks, and 52 weeks. In a treasury bill arrangement, you agree to give the government X amount of money, and then they'll give you your money back plus a little bit of interest. The amount of interest is determined by how long the debt period is, which means the shorter the debt period, whether that be 2 weeks or 52 weeks, the less money that you can expect to get in return in interest from the government. The next 15% is another type of bond. This one is called a Treasury Inflation Protected Security, also known as TIPS. To put it simply, this bond moves with inflation, which means you're guaranteed to never lose your original investment. So let's say your $100 today is worth $97 next year. That means you've lost 3% of the value of your money due to inflation. Essentially, when the government issues you this type of bond, that just means that you're going to be locked in at that $100. So now you're going to be getting that $100 plus 3%, because now your $100 has the same buying power as $97 last year. So to protect against that, the government uses these treasury bonds. The final 20% is in real estate investment trusts, which is also known as REITs, if I'm pronouncing that correctly. A REIT, or real estate investment trust, is a type of company that owns, operates, or finances income producing real estate. These can include properties like work offices, apartment buildings, or even shopping malls. A REIT is a good way for an individual to invest into a large-scale real estate portfolio without necessarily having to manage and maintain the real estate themselves. So as you can see, the Yale model is very diversified. So you'll have to go into your investment account and make sure that your portfolio is balanced in that way: 30%, 15%, 5%, 15, 15, 20. And every 6 months or every year, you're going to have to log into your account and manually sell off the parts of your portfolio that are overperforming and buy into the parts that haven't been performing as well as the other parts. So you always want it to be balanced in that same way: 30, 15, 5, 15, 15, 20. Honestly, the Lifecycle Fund is a lot easier to manage. You don't have to log into your account and constantly check and sell off a little bit of portfolio and buy into other parts of it to make sure that everything's balanced perfectly. It does all of that automatically for you. So you can take the easy route, which, you know, normally they say things that are easy aren't worth it. This is definitely worth it. The Lifecycle Fund, or the Target Date Fund, is easy. It's going to help you grow your money. Or you can do the Yale model. It's completely up to you. I've given you both options. You can do whichever one that you want to, but just make sure that you're investing in your 401k, because your future self is definitely going to thank you for it. So hopefully you learned something today that you can use to create the life that you want to live, and I'll see you in the next video.